Hello, everybody. Welcome to Analyzing Finance with Nick. I have a special guest here. He's a former colleague of mine, one of the brightest minds in options and market making and how that matters to people who aren't in the world of options and market making. I'd like to introduce Kris Abdelmessih. Kris, can you tell people about yourself and your background?
Sure, Nick, it's a pleasure to talk to you again right now. We used to talk on a very regular basis, so it's fun to be back here. So, yeah, I was an options trader professionally for over 20 years. I started at SIG back in 2000. I grew up on the East Coast in New Jersey and went to SIG right out of college, went right to the American Stock Exchange, traded equity options down there. And then after a few years of trading equity options, I traded ETFs a little bit on the New York Stock Exchange. And then that was when my career really changed. I went over to commodities in late 2004. I went to the NYMEX to trade oil options. That was a brand new business for SIG. And I stayed there for a little over 3 years and then went off on my own with a backer, traded commodity options mainly focused on natural gas, but then went into gold, silver, coffee, cotton, all that stuff. Did that for about 3.5 years, and then I ended up at Parallax. And I was at Parallax for almost a decade, and that's where you and I crossed paths. So I ran commodity relative value options trading at Parallax. And then I left Parallax in 3 years ago. I have been writing since early 2019 on the internet, and the writing's it's gotten a lot of traction over the last few years. So these days I'm focused on that. And then earlier in March, I launched an options analytics software called moontower.ai. So between the writing and the software, that's pretty much how I spend my time today.
Yeah, and the first question really is given your background in vol trading and more my background as a directional investor, what do you think is the main differences in the approach between directional trading and vol trading?
Yeah, so here, well, I would say, first of all, let's just to back up for a second. The difference, the first thing is like the first difference between them is like the instrument that you're actually trading. If you're a directional trader, you're trading an underlying asset. You're trading whether it's a stock or a commodity, a corporation, versus if you're trading vol, you're trading options. And vol trading is options trading. So, and options are derivatives. So the value of the option is derived from the way the underlying sort of behaves. So, unlike a stock, they have arbitrage boundaries, they have expirations. So the way you can think about an option is its value is derived from the cost it would take to replicate the exact same option. So a vol trader, you can think of a vol trader as somebody that says this option, most of the inputs that go into that replication are fairly well known. The one that's not very well known is the volatility because we don't know how much a stock is going to move around in the future. So and what an option trader might do is sell an option that they think is expensive, and then they would hedge that. That's called delta hedging. And in that process, they're trying to replicate the payoff of that short option by basically creating a long option. So, and if they are right about the price of that option being too high compared to how much the underlying moves, there will be a differential that ends up being their profit. So, in short, like the way I like to think about it is that a directional trader is somebody who has a opinion about what's going to happen to an asset, whether it's going to go up or down. Sometimes directional traders use options, and oftentimes they don't necessarily have an opinion about the volatility. That's not their expertise. Their expertise is in understanding if this asset is over or underpriced. A vol trader is in the exact opposite situation. They believe that the underlying is fairly priced. They don't have a view on the underlying, but they might have a view that the option is mispriced and the volatility is either too cheap or too expensive. And what they can do is by delta hedging, they are sterilizing that position against the movements in the underlying and trying to isolate the thing that they have a view on, which is the volatility. So that's the main difference between a directional trader and a vol trader. Like one has an opinion about the underlying, one has an opinion about the vol.
And do you think there's more edge in trading for the vol versus the underlying? I've learned this the hard way because I only did like one options trade before I joined Parallax, and that was buying Twitter puts for 6 months out. And the implied vol was so high that those puts were worth 20% of the whole company. And the stock went about 19% in those 6 months. So I didn't make any money, even though it pretty much moved the way I expected it to because I lost on the
Right.
vol trade. Is it because people are less informed about this element? There is more of an edge in vol trading, or is it kind of an even game between directional and vol trading in terms of actual alpha or edge?
It's a this this is a it's kind of an abstract question. It's very interesting. So one of my I'll just tell you sort of like my feeling about it, which is that I think that options trading is easier than I think it's easier than having an opinion on what's going to happen to a stock. Actually, in the quant world, there's a good reason for this. It's that it's almost impossible to predict asset returns. It's much the easiest thing you can do. If we think about the three like biggest elements from quant finance, there's volatility, there's returns, and there's correlations. And volatility is the easiest thing to predict. It's not easy, but it's the easiest of the three. Asset returns is by far the hardest and pretty much impossible to predict. And then correlations kind of live somewhere in the middle. So volatility is easier to predict. The problem is like this is a game. So the fact that it's easier to predict doesn't mean you're going to make more money trading options because it's also more competitive. There's less because there's a little bit less uncertainty about what this option could be worth. And you have a lot of very smart firms chasing this, and it's a zero-sum game, and it's a small part of the overall market, which needs to allocate capital. The derivatives market is just a fraction of that world. All of those things add up to it being incredibly competitive. I mean, I have a friend of mine, Augustin LeBron, who wrote a fantastic book called Laws of Trading. And I think he's the one that's got a saying that's like, there's more houses in the Hamptons built on investing than on trading derivatives. And I think that there's a lot of truth to that. It's just way more competitive to trade derivatives in a much smaller market.
And how does the mean reversion nature of vol affect this? And why does vol mean revert?
Yeah. So we can think about it a little bit in a theoretical way, which is where the short answer would be like, because it can't not mean revert. And the reason why is because you could not, if you took the volatility of an asset to infinity, that means it would touch zero very soon. If it just bounces around at infinite fall and zero is game over. It's an absorbing barrier. So if vol were to go to infinity, that would end the game. So we know that the vol must come down from very, very high levels. And it makes sense that that would also happen because at any asset at a low enough price, presuming it's not a fraud, an asset that's at a low enough price, there's some bid for it. There's some price that makes sense. So at some point, the cheapness of the asset itself will bring about its own liquidity. At some point, there's a bondholder that will just take the stock over. So
Do you
there's a
think that
bid.
with something like cryptocurrency, though, that may not apply because it has no intrinsic value?
What I would say there, it may not have an intrinsic value in the Ben Graham sense of the word, but it has a value in terms of what somebody is willing to pay or not pay for or sell it for, right? Like everything has a value that's based on that bid ask when you pull it up. And so there's some price at which somebody will bid it.
I got
And
it.
that fact alone is enough to kind of force the idea that volatility does find some mean reversion. Eventually, you basically find if you look at a long-term average of its volatility, they're fairly well behaved. It's not enough of a it's not true enough that that's useful to necessarily trade around. It's too low res to make money off of that fact, but it's enough of a resolution for you to be able to see that volatility does mean revert.
Yeah. And so then on the other side, why does vol come up then from the ultra low levels and mean revert higher? Like it's like VIX historic is like 15, but you see some regimes where it's 9 to 12, but they usually ends up moving back to the 14 to 16 level when it's all said and done.
Yeah, so I would say the vol comes back up because that just comes back. I think it comes back to, first of all, there's always uncertainty. So because we don't know what the future holds and the distribution of events that's in the future is, you're sort of bounded at total quietness on one side, but a bomb could fall somewhere. And so there's always this possibility that an extreme stress event can happen. That's always possible that, I always like to say like the biggest disaster is always in the future. We haven't seen it. So the fact that the future always holds some possibility of there being something very surprising sort of guarantees that the volatility should not get too cheap. The implied volatility cannot get too cheap. Even when you see cases where the realized volatility or the way that the asset has been moving, that can drop to really low numbers. You can see the S&P get down to like 4 or 5 vol over very short time periods, but you never see the implied vol get that low, because if it gets that low, everybody sort of says like, well, yeah, but I don't expect the future to be 5% vol. So there's that mean reversion also happens because we know that when a time is quiet, we know it's going to pick up again at some point.
Yeah, and this kind of goes into what my thoughts on this from a more directional perspective. Some of the lessons I learned on a vol desk is that you can kind of use this to your advantage. Like if you're going to try to, I don't to magnify your returns through buying options instead of stock, they call this a stock replacement, where you sell a stock or you just add to a position via a call or a put instead of just adding or increasing to your long or short in the underlying, is when these vol is below the historical mean. It actually makes sense to do that. Whereas on the other side, when vol is extremely high, you're better off oftentimes just selling the puts versus buying the underlying and collecting that premium. And because if it goes another standard deviation lower, that's like the deal of the century, assuming you've done your fundamentals right. And if it doesn't, you collect a nice premium to wait through the chaos. And other than like that's the most notable example, I think, in terms of how more directional traders can use this, and they should be aware of the level of the vol, because you don't want to overpay for volatility like I did back when I was a rookie options trader. On the long side and on the short side, you don't want to underpay for it because the payouts with options are mostly zero sum. Like more times you're not, the seller is going to win, but when the buyer wins, the gains make up for all the times that the seller did it. So what are your thoughts on how directional traders can utilize this type of perspective to help them be more smart with how they use options?
Yeah, so I would say that so this is in a large way, this is the problem we're trying to solve with the software, is that what we're trying to do is give people the volatility lens. Like I said earlier, most directional traders usually don't have an opinion about the volatility because that's not their expertise. So they are coming to the market, they have a bias, they want to go long or short the underlying. And so what they do is they look at options as these just little directional bets. It's like there's a back when I was a long time ago, back when I was like 21, 22 years old, I had a friend, I was a trainee at SIG or whatever, and I had a friend that was in a residency to be a doctor. And so we would go out on, Friday night or whatever, and he knew that I was doing that work, and I knew he was trying to get through his residency, and he would joke around with us like, "How's it going over there with you guys and your puts?" And I always laugh at that even today because it is actually how most people think of options. They just think about them as calls means go up, put means go down, and they just think about them directionally. And what we're trying to show people is that options are fundamentally and always about volatility. So it does not, you can divorce direction from volatility. If the options price is high and you're bullish, you can do lots of things. You can sell calls and buy the stock, which is the equivalent of selling a put. And you can pick where on the surface you want to do that. If you think the option is cheap and you're bearish, you can buy puts. If the option is cheap and you're bullish, you can buy calls. But no matter what the option market gives you, there is something to do. Like as long as if you have an opinion on the option and you have an opinion on direction, there's always something to do. And that's what we try to show people, is that you don't want to come to the market with this like monolithic point of view, like I only sell calls, I only sell puts, like that's all I ever do. It's more of the option market is presenting opportunities to you, and you can marry that with your directional bias to find the right trade. So what we're trying to do is make a directional trader be vol aware and be like, hey, you have this bias, fine. Now we can just walk through a flow chart and say, okay, I'm bullish, the vol's high. Okay, I can sell calls and buy the stock.
Yeah, that's kind of how I try to do with my own process. I use options for my clients in selective circumstances, mainly for hedging, but for more speculative ones sometimes in the directional area. But I always want to be vol aware because if you overpay for vol, it greatly affects your risk reward payouts.
Totally.
And then the next thing I want to speak about, let's go to a example. And just as a disclaimer, I have to say, like, nothing we're talking about is investment advice. Please do your own research or retain an advisor to help you with your specific investment needs. And if you have any specific questions about your own finances and portfolios, instead of commenting them here, just reach out to me directly through email or my website. As for an example, though, let's talk about covered calls. I did a video criticizing covered calls last year in December, and I keep getting asked a lot of things about like JEPI and these similar type covered call ETFs, and a lot of people just perceive them as like a free 8% return, like buying like a high yield bond without the default risk. Whereas I don't think the real payout is that great. And I'd like, and you're better at explaining this to me because reading your post was what inspired me to make that video. What is your thoughts on the covered call risk reward payout, and why isn't it as great as it is commonly perceived by retail traders?
Yeah. So this has been a little bit of a hobby horse of mine. I've written multiple posts about this topic, trying to kind of peel the orange from a few different angles to try to make it clear. Let me give this a shot here. So first of all, the whole covered calls things is incredibly popular. And I think that there's a large incentive to promote them because, whether you're person is trying to sell subscriptions or whether a brokerage or whatever is trying to get you to churn option contracts 12 times a year by selling these calls over and over again, whatever it is, there is an incentive to promote people to do this. And the incentive comes from the fact that when you sell an option, you usually win. And which says nothing, as you know, like about the expectancy of the trade. It's just that you happen to probabilistically, you're probably going to win. So you can kind of, if you are devising, let's say if we're being very cynical, it says if you were devising a grift, you would always start with something that won most of the time because that's the easiest place for the grift to hide. So there's this big incentive to push selling calls, and this whole framing as you're selling this option for income. This is what really sort of irks me because to call it income, I think is really disingenuous. I'll give an example of why it's disingenuous. Like, let's just take a special situation stock. We'll say it's $100 because it has a 10% chance of being worth 1,000, and it has a 90% chance of being worth 0. So the stock is fairly valued at 100, and maybe it's a biotech stock that has an FDA ruling coming out. It has this crazy looking coin flip of it. It could be 1,000 or it could be 0. If somebody said, what's the value of the 500 call? Well, the 500 call has a 10% chance of being $500 in the money. So the 500 call is worth $50. If I go and I sell that call for $40, have I made any income? And I would say in a pure cash flow accounting sense, it looks like income because money comes into my account, but I destroyed value by selling something that's worth $50 for $40. And that's obvious because if you did this 10 times over, you would see that the expectancy was negative. If you played that game 10 times and the stock hit 1,000 on one of them, you would be net P&L negative on the entire strategy. So if you sell something, just because you collected premium up front doesn't mean it's income. The point is it's only income if you sell it for more than it's actually worth. So, and that really kind of goes back to a point that I think is important, which is like with trading in general, you really need to think about these things as sort of like a repeated game. If somebody goes out there and they sell a 25 delta call every month, that is pretty similar to just selling 25% of your stock holding every month. It's just that the shape of the payoff looks different. And you can tell that you're short. You can actually understand this idea of being short vol or long vol from that counter example where you say, if I would have just sold 25% of my shares and the stock would have went to 0, I would have been better off than if I was long 100% of my shares and just sold a call option. If the stock price doubled, I would have been better off to only have sold 25% of it and rode the other 75 up 2x rather than selling a call. So on extreme move, I would have been better off to sell a portion of my holdings rather than sell the option. So you can see that in either direction, you're short vol.
Yeah.
So the covered call world sort of hides behind like, oh, if you go up, you're going to be happy anyway if the stock gets called away. Well, if you do this on a repeated basis and you keep cutting all your longs, you're going to be sad because
Yeah.
nothing is cutting your short, nothing is helping you when you lose all your money. Like nothing is saving you in that case.
Yeah, because I ran the numbers on this, and I'll have a link to the video in the description. But basically, if you did this on the S&P 500, most in your average yield was like 7% on covered calls. You would the most up years in the market were double digits. So you're always giving up something. And the reason why the market average is say 7% over the last 20 years. And the reason is because it goes up double digits every up year, and then the down year it goes down 25 to 30. So you're still going to you're going to eat most of the loss, but you're going to be giving up most of the upside.
100%. I always kind of think it's a strange choice because the reason the stocks are in your portfolio is because they have this really large upside. As a matter of fact, I think if you go back and like look at the history of stocks, like, the average life of a stock is not like forever. Most stocks actually go to zero eventually. Like
Yeah.
it's
Well, that's the
so
other thing is the distribution. Like if you're going to do this, you should sell the call to buy a put and to just lower the cost of hedging if you have like cost basis or other reasons why you need to do that.
yeah, it's kind of for me, it's like my I'm often I guess I just this is I guess what I wish people would do when it came to covered calls. It's to just get rid of the framing that this is I'm selling these calls for income because that's just an illusion. It's not income. And instead, if you want to sell calls, it's okay. Let's just understand why one would sell calls. And if the thesis is this option is priced, that's a totally fine reason to sell a call, but that's not really where the discourse is. People are trying to be like, oh no, it's like free money. It's like, no, there's an exchange of value going on here. This option is worth something. And just because you sell it for some positive amount of money doesn't mean you actually made a profit.
Yeah. It's kind of like in the mid 2010s, like I was in the hedge fund capital raising world, and they would always have the funds that always have the best sharps and the best sortinos were these vol selling strategies. They would sell vol and they would have very smooth returns, and they didn't really have any real drawdowns, and they looked perfect for allocators. But then whenever you had like a giant spike in vol, all these firms would go bankrupt at the same time. Like I remember in 2018 during Volkswagen, like in February, there was like everybody like they were getting rich buying XIV, if you remember that ETF.
Yeah.
And then one day it just didn't the volatility went up for some random reason, up 50%. Since it's double short, you're everybody got taken to the ambulance. It was done.
Right.
And like that's like it seems like that a lot of institutional alligators have wisened up since and don't really buy those things, but that seems to be like the same play on the institutional level are these sell vol type alternative funds.
Yeah, I mean, we see it. I mean, this kind of sort of like carry hogging, yield hogging idea. I mean, it exists in other markets, not just purely in options. I mean, even if we look at like these 15-20% yields on yield, like the yield farming stuff in crypto. I mean, it's all a variation of the same theme. You are getting paid handsomely to take a very skewed bet. That's essentially what's going on there. And so I don't, it's just that the covered call discourse does not look at it that way. And it's not as extreme. It's not obviously as extreme, but it does mask what's actually happening, which is you're just doing a vol trade.
Yeah, if you really look at it, and this is gonna kind of we're gonna zoom out to the macro now, that kind of every trade in the market is a vol trade, and even beyond that, every like life decision is essentially a vol decision. I remember back when I worked on the desk with you, I read this article from Kris Cole named Volatility and the Prisoner's Dilemma. And it's about this idea that basically every decision you're making is either a long vol trade or a sell vol trade. Like you're either paying a small amount that you're likely going to lose, but you get a big payout in the event you're right, or you're getting a small piece of gratification now and you lose big in the event that the tail event happens. Like a good example of this for the long vol would be like if you're a single guy and you ask a woman out on a date out at an event, like 95% of the time you're going to get told no, but the cost is a little bit of your dignity. But then there's maybe a 1% chance that you meet your future wife and it pays for all the rejections. And then the opposite side is like driving without a seatbelt. Yeah, it's more comfortable maybe to drive the car without a seatbelt and you'll be fine 99.5% of the time, but the one time you get in a car accident or hit the brake too hard, you're flying out the windshield and you're dead. So the loss from that is worth more than all the minor joys of being able to drive without a seatbelt your entire life. And it doesn't just apply to these two examples. Like every decision that most people make fits into one of these two frameworks. And I was wondering what you think about this concept that basically every decision you make is a vol decision.
Yeah, here's what I'll do with that one. It's I'm gonna piggyback off of some of my training. So, I started at SIG, famously or infamously, or at least in our little world, like Jeff Yaz has he said that you cannot be a sound decision maker without understanding option theory. This is I'll say that's a heavy-handed way of saying that, but I do think that what he's really pointing to when he says that is that decision making is a practice that has inputs into it. So, for example, like what you just described, you talked about the understanding the asymmetry or the risk reward of a choice. So, an option trader would call that skew. That's an input into your decision. It's like, I'm looking at this decision. What's the risk reward? That's one component of it. What's the skew of this decision? A second thing you could say is accounting for the opportunity cost. So if you look at in options theory, we have this idea of like in arbitrage pricing, we think about the cost to replicate. So for example, actually think about a futures contract. If you go out to buy a futures contract, if you tell me that there's a futures contract, if I go buy an S&P future and I don't have to put any money down or just a small deposit down to own this future, well, then if I buy that future and I don't have to put any money down, then I could have taken the money I would have put into the S&P 500 and I could go earn interest on that money plus have the exposure to the S&P future. So if that's the case, then if I'm just comparing buying stocks, I'm thinking, wow, my opportunity cost is really high. It's the interest that I could have earned if I would have just bought the future instead. But because of that, the future trades at a premium to the spot. So there's no arbitrage there, but the entire pricing framework was aware of the opportunity cost. So if you think so, options theory very formally incorporates the opportunity cost into how to think about the value of anything. Another thing that comes out that's very important in decision making, a third component, is appreciating second order effects. I had read this. It's one of these things that I don't know if it's true or not, but like I read this thing called a Cobra effect, and apparently, like in India or something, there was a big problem with snakes. Like this sounds like a fake story, but like it sounds like there was a big problem with snakes, and so they put a bounty on the snakes' heads and said, if you turn in the snake, we'll pay you, this many rupee or whatever. So the first order effect is to say, oh, if we impose this bounty, we're going to catch a lot of these snakes. But the second order effect is people just start breeding the snakes and then killing them. So you end up with more snakes than you started with. So it's like appreciating that second order effect. And like in options, what is the second order effect? It's Greeks. It's just gamma is the second order effect of Greek. So all these things that you have to think about when you make a choice, the risk reward, the opportunity cost, the second order effects, all of those components, they're so formalized in option theory that you can kind of see how thinking about options helps you be a better decision maker. You and I both have a presence on the internet. You have a YouTube channel. I have a Substack. If you think about having something like a Substack, the decision to paywall or not paywall is a options decision. If I paywall, I make more money today, but my reach is going to be smaller because I've paywalled. So the question is the second order effect of the fact that my stuff gets shared more because it's free, that some inbound that I may get because the reach was further, a bigger payoff than what I can harvest today from putting a paywall on there. I write a lot. I paywall a tiny fraction of the amount that I publish. And it's basically right out of this options thinking. I think the reach is more valuable than like the coupon I can clip today.
Yeah, I mean, this always reminds me of Howard Marks wrote a book, I think The Most Important Thing, which it's all about second order effects. And I think the biggest flaw really in modern society, particularly in the United States, is people don't see second order effects very well.
Yeah, I've often thought about like it's like one of the like joking kind of ways of kind of characterize like I would say like the right thinks everything's a slippery slope, and the left thinks that, and the left ignores second order effects. I mean, it's kind of like if I had to like put a label on both sides, that's often how I felt about the two
That's
second.
actually a great way of putting it.
Yeah,
And I think that second order effects really, I've really built this entire channel on analyzing second order effects. That's not all I do, but it's at least like half the videos. I either directly or indirectly bring up second order effects of things going on in the markets and the economy and what they mean for the broader culture. Like, I think the biggest second order effect that nobody really anticipated was TARP. Like, in the first order effect, the banks actually made the government a profit. They paid back very high interest rates, all the money that they lent. But you set the second order effect of precedent is that, look, even if these most big irresponsible banks who made bad bets on the mortgage market, they're going to get bailed out, and even they're the most well capitalized people in the world, why shouldn't I get a bailout? And we literally have a political culture, a social culture, all built really basically from TARP to present that everybody should get a bailout. Nobody should be accountable for their misfortunes.
I
Whether
mean the GFC is there's a direct line from the GFC to Satoshi, right? So
yeah.
it's 100% like I completely agree with you. I think that the artifacts of the GFC were so they're still really being felt today. I mean, I think it kind of altered the course of economic history here. So I would totally agree with you on that.
And speaking of that, it kind of leads to the next point I want to make is that a lot of the impact of the second of the GFC and the loose monetary policy that we've had from most of that point since then has created like this culture of financial nihilism. I don't know if you're familiar with Thomas Kling's paper about this.
I'm not.
Okay, it's the idea that a lot of younger people, particularly like 35 and under, they feel like they can't save enough money working hard the honest way or investing because valuations are too high for both stocks and real estate. And if they ever want to be able to afford a house or to afford retirement or to afford to have a family, what they think that they need to find something that's going to get them more juice, like the 1,000% plus return. This is explains like the mindset towards crypto, the mindset towards like parlays and sports betting or zero DT options. It's like, look, I need these returns. I don't care if I lose 2,500 bucks betting on this because if I'm right, I can make 1 million and it will actually change my life. Whereas if I put that $2,500 in an index fund and it's worth $5,000 10 years from now, that doesn't really move the needle for my long-term fortune.
Yep.
And
I was gonna say this is what's it's not amusing, but it's I find this kind of resonant because I think one of the things that I feel like when I look around, it's almost like being serious, trying to do good work, being humble, things that are basically things that date me as because I think that these are virtuous things. It feels like if these things matter to you, you're a sucker. How I feel like when I think it's very hard to look at, somebody that the whether it's the SPACs and the guys that pump the SPACs or whether it was with the Hawk Tuah girl. I don't even know how to say this. I don't want to go there, but she launches the coin, and of course this is not an investment. It's just a pure gambling token, but if it enriched her, and you're kind of, I think people look at this and they say, what's the point of like working really hard if this is what we're rewarding,
it's
just
common among
debauchery?
Gen Z circles that like they think that the market is just a game of random chance. And so that's why also you have quiet quitting and people doing the minimum because it's like you're not getting rewarded to advance. And then this starts to age me too because I feel like at least living a life of integrity, even if it takes me longer to get ahead, at least I could sleep at night and know that I'm actually doing my best to be a net benefit to society.
Yeah, I yeah, I would say like if I had to like think about my view here, it's really I'm sympathetic. This kind of falls into like I'm sympathetic to this nihilistic view because I do see the same things. You're looking out there and you're saying like, my God, did we just live in an age of unserious grift?
And then you forgot about the tech unicorns up in San Francisco for most of the 2010s, where these companies are getting just for being a dropout Stanford, you raised 10 million bucks for a venture that has nothing but vapor.
Yeah, but even then, I mean, there was the joke like this is another ZERP phenomenon and all
Yeah.
that. But then, we have a real interest rate the last couple of years, and it does not. And this year, the insanity of 2021 feels like it's kind of it's reemerged, and our interest rates are much higher. It's not. I think this goes deeper than ZERP. It's cultural in some way. I think what I would push back on like and this is just me, maybe this is me being a dad, but like pushing back on this that financial nihilism. I'm sympathetic to why people might feel that way, but I think it's a bit of helplessness to adopt the viewpoint to think that you have to gamble your way into a better station in life, because at the same time, there's less gatekeeping. You've got a YouTube channel. It took you 3 years to get to where you are today on that. It's growing. Nobody could stop you from making the YouTube channel.
Yeah.
So I do think that there's a lot of opportunity out there. Nothing's easy. Nothing was ever easy. And it's going to be competitive the whole way. But there is, for somebody that wants to work hard and do well, I think that you have way more opportunity. Things are very democratized in that regard, relative to the way I think people like to look back and think like, oh, there was like some halcyon time where like it was easier or something.
Well, yeah, I actually think for your kids' generation, and whenever I have kids, my future kids' generation, that will be the easy time just because the nihilism is creating low birth rates and less competition. But like I know like when I graduated from college during the GFC, most of the big investment banks and hedge funds and long only mutual funds, they only wanted to hire people from like 10 I like select schools like the Ivies plus like Stanford and University of Chicago. And I went to a quote unquote non-target at UCSB, and I was just told you're not smart enough to be here. And like I found my niche. The options firms were more merit based. They just wanted more just like talent and deviant thinking. And so even in this, and so like today, I see these same big prestigious white shoe investment banks and hedge funds and mutual funds. They're recruiting from the UCSBs and the UCLAs and Notre Dames of the world. They're not just going after the Ivy Leagues. It's a lot more, I think, meritocratic. Just that's just one example is the buy side in the financial services industry. I don't know if you've seen that trend among hiring in our industry, but I've definitely seen that's the case.
I think well, I think one of the things that's happened, I actually would say that's probably less true in the prop firms. It's different. There's been a lot of consolidation in the prop firms over the last 20 years. So, Sig, Citadel, and Jane make up a very large portion of like the market share, say like in options. And they're all competing for the same kinds of people that an AI company is competing for. It's like they're going to Princeton and saying, "Give me your top mathematician." And they'll pay them a ton of money at 21 years old. And in a sense, these firms are basically looking for X men and X women today. They're looking for super accomplished people. Now, that said, I think that the antidote to this, even if we were to say that there was a bunch of credentialism that felt insurmountable, that was creating more nihilism, I would push back against that and say, well, we live in the show your work era. You can
Yeah.
just go on the internet and show your work. And if you build a following and if you do good work, you can create quality. I'm very active on X, and I've watched it repeatedly. People that have kind of come out of nowhere, demonstrated that they were very smart and very hardworking, built up a following in X, and parlayed their virtual status to great jobs and great positions. So
Yeah, I kind of did
again,
that with
it's not
Seeking
easy.
Alpha in a way.
What's that?
I wrote for Seeking Alpha when I was first out of school before I broke into the industry, and that's how I got a lot of my original breaks, was people saw me there.
Yeah. I think you just have to remember, like, there's just nobody's going to hand you anything. So if this road feels blocked, you got to route around it. And I just think that there's more ways to route around it today. In 1985, there was less ways to route around it. And for people that kind of romanticize those times, I think that's an illusion. I don't think that it was bad. I grew up in a place, in a very like insular town in central New Jersey. I was very underexposed to what was in the world. It wasn't like I could go on the internet and expand my horizons. And I think that, and I've like, actually, I think in some way I've felt it as an adult. Like I like being an adult way more than I like being a kid. And I think it's because I felt a bit trapped when I was younger. The world felt small and I felt like I didn't necessarily belong where I was. And so that's my counter to all this, all this nihilism is like, you choose what to focus on. Your attention is under your own control, and every resource is out there, oftentimes for free today. But you need to be resourceful. You need to have a strong sense of personal agency, and this is a great time for you.
Yeah, and that leads to the question I was originally getting to, but this was a great tangent, was has the financial nihilistic attitude and people's higher propensity to gamble, quote unquote, affected how options are priced and how people are managing risk?
I think, well, so we learned some new things. So in 2021, we learned just how screaming high calls can go, as there was all this lotto ticket type driven purchasing, and then we saw the ability for Wall Street bets to essentially organize in a digital forum and create its own momentum. And that I would say on the first leg up on of all of that and the first leg up on GME and all those things, obviously I don't know for sure, but I would be shocked if the market makers didn't a pretty substantial hickey on the first leg. Now, the trading firms are their whole MO is survival. They know how to manage risk, they know how to adapt, and they know how to size things. So if they took it and then they learned, and this becomes part of their pattern library, and they say, oh, sometimes people are going to band together and try to do this. So what they might do is they might raise the vol aggressively when they first see the first signature of that kind of order flow. And if you raise the vol aggressively, the vol will just be too high. The options will have less gamma mechanically because the vol is so high, and that trade won't work anymore. So what happens is, like I always say, like, you can beat a market maker once, but you can't beat them twice because they've seen the pattern. And so I would say that the way that single stock calls were priced, they caught a new bid. People probably be less wary or more wary about being short them because of what's happened over the last few years. Overall, I think this is a bonanza for the prop options trading firms because you have a bunch of essentially noise traders coming in there and punting, and you can kind of see it. I think I saw that Jane Street has made $14 billion through the first 9 months of this year, after the last 2 years being a $9 billion years each. And those were records. And now they're $14 billion in 9 months. I think that the prop trading firms are probably crushing it. So I think all this activity has been good for them. But all the ways in which options have to have been repriced based upon the way retail is behaving, I think does get incorporated into the market very quickly. So, like I said, call options are they're going to be actually, it's a good argument maybe to be selling covered calls now, because they might be more expensive on average than they have been through historical periods. I wouldn't take that as advice. I'm going to go study this rather than, I'm just guessing. Overall, I think that my hope is that, you get a bunch of people that came here for the gamble, and some of those people, a small subset, will peel off and be like, people probably lose money because they didn't know what they were doing, but some group of those people will be curious and say, you know what, I actually like to learn more about how this works. And some set of the people that came over just to gamble will become dedicated learners. And I think we'll find that options investing, options trading, it's a very cool discipline. It's a very cool thing to try. It's very interesting. It's a bicycle for the mind. It's a great way to express a very surgical view on something. I don't think most people should be trading options, though. I think like the people that have seen it and have decided, you know what, I actually want to get good at this, or I actually want to try to get smart at this. There's never been more resources available for free on the internet to learn. All this stuff that exists about options today, the fact that people even know what Vanna is or what Gamma is, that's more common to know that today, speaks a lot about how the knowledge has been democratized over the last 15 years.
Yeah, I mean, it's easier now than ever to learn about anything really in the financial markets. This channel is just one example of many like free outlets where you have that. Um, I just still think options are best used sparingly, even by professionals on the directional side, because given how we've discussed before, it's most of the time it's a pretty efficient market. Like I would argue the vol market might arguably be in some ways more efficient than the directional market. just because of the mean reverting nature of it.
Yeah, I think that there's probably less opportunity for it to be displaced versus, like I said, yeah, mostly because it's a smaller market and there's a lot of competition in that smaller market, but it still gets, because it's a smaller market, the liquidity, like you do get more sort of like vacuums in liquidity.
Yeah.
And that's those displacements in liquidity is where the sort of opportunities arise. Whether it's correct for somebody to go seeking that, really, you really need to have a framework. You have to have an approach for doing that, and you have to understand how to manage the risk around those kinds of trades. But that is sort of the flip side. It's like the liquid. I mean, the options not being as liquid as an underlying is a double-edged sword. It's both danger and opportunity.
And then before we wrap things up, do you have any final comments that you'd like to say to the viewers about vol, options, markets, anything?
I would say that I'll just kind of reiterate my view on options, which is that they are surgical tools. They're priced for specificity, meaning that if you have a view on a stock and a time frame with that view, an options price is highly levered to that outcome. But that also means that if you're very wishy-washy about what your views are, you probably just want a blunt implementation of your trade, which is probably to just trade the underlying rather than this situation where you're bearish on a stock, but you're really wishy-washy on your
You don't know what the
bearishness.
end point is, basically. You need to know the
Exactly.
end points to
Because
succeed.
you don't want to buy, the worst thing that happens is like you buy an out of the money put, you overpay for the vol, you're completely right on the stock going down, and then you still manage to lose money.
Yeah. And then how can people find you if they want to read more of your work or learn more about your AI software or really anything else you're doing?
Yeah, the two, if you want to go right to the software, it's moontower.ai. The great thing about that is the learning materials for that are all free. So there's a lot of education that's available there. And then the main place where I really live is the Substack. So moontower.substack. And from there you can find all my writing, you can find my social media, all that stuff. But moontower.substack is a great place to start.
Yeah, for those who like my Substack, I think you would like Chris's. It's one of the few Substacks that I regularly read myself. And he's all about options and also about using that options trader's mindset to understand the second order effects in other parts of both markets, investing, and life. So I recommend checking it out. And thank you, Kris, for joining us. And yeah, we'll be back with more of these interviews in the future. Thanks for watching.